everybody. Welcome to the Enlightened Investor Show. This is Dr. Lure from Bradley University, and that there is Mr. Mike Mahoney from Cypress Asset Management. I call him Mr. Fiduciary.
And the professor.
And the professor, yes. I'm the stock. I'm the bond. You're the stock.
Right. We'll explain that.
We'll explain that. Folks, I think this is perhaps the most important show we've ever done when it comes to the investing side of this show. And really, what I want to impart upon you is that I see so many people out there in the world today just throwing money at risky, high return, high risk assets that they feel, hey, this is how I want to invest. And I think there's sort of a lack of discipline for people to say, gosh, I'm going to build a portfolio that's going to last and is going to perform and perhaps even outperform the overall indices. And that's what today's show is about, is that you can win and take a little extra risk, yet keep your standard deviations lower by just following some basic evidence-based investing that we're going to share with you today that no one talks about. So, Jeff, if you could just hang in here today, folks, stay with us. We've got
hang in there.
Yeah, I know there's going to be a lot.
It's going to be good.
It's going to be valuable for your financial future. And don't forget what Warren Buffett says. He said the stock market is a device for transforming money from the inpatient to the patient. Our plan over time has shown, building these portfolios have shown to outperform and reduce risk. So, Mike, with that, let's talk about build. This is our design, build, protect, episodes. Let's talk about the build
I think
portion.
I want to remind people where we've been to get to this point. Is we started with design, and with design we walk people through using Monte Carlo to set your asset allocation based on whether you're still accumulating or whether you're spending from the portfolio. And now we're going to get into the actual where the rubber meets the road. We're going to build the portfolio. We're going to show you, there's different approaches you can take. The problem is out there, what I see, Joshua, is not everybody's taking too much risk because there's so much sophistry and misinformation in the industry and salesmanship too with product manufacturing. And a thing I see a lot of lately, and it's been a number of years, probably since 08, 09, this really became much more prevalent when we had all this volatility, is they sell about $50 billion a year of these indexed equity annuities out there. And they are incredibly complicated. They were very rewarding for the people that sell them. I think the commission's like 8%. But long term, the returns are close to like a CD. Right. But they make it sound like you can be in the market, and we'll talk about that in another video. So I see a lot out there, but I don't see many people that have a coherent process that's based on any evidence and other than chasing past performance, which the data shows that that's not the process to have success. I mean, that's just randomness.
Yep. And those high fees, we're going to talk about that. Those high fees, the hedge funds, those will kill your performance.
Correct.
So let's dive right into building a portfolio.
So we're going to use academic and theoretical data and research, much of it's Nobel Prize winning, to show you how to build a portfolio and increase your odds for success, right? And you start with asset allocation because the data's out there, and there's a resource, and this is from Vanguard's website. There's studies out there that's shown that over 90% of the variance of your portfolio, your holdings, is driven by asset allocation, and only 9% is driven by security selection.
Yep. That's incredible.
But if you look at the industry, it's all about security selection. I mean, there's a local advisor. They pick 70 to 90 stocks, and that's their focus. And the collective wisdom of the market is much smarter than any local firm. And we'll show you the data on that as well. And I think this is great data here that just show people why is it so hard to beat the market and why returns are positively skewed and what that means for them and why stock picking really becomes a really hard hurdle to overcome. I mean, you look at this data, this is 20 years at the S&P here, right? And the average cumulative return for the S&P was 239%. The median return, though, was 52%. And if you look at the far outlier, the number one, that was Apple 9,000% cumulative return.
Yeah.
But then if you look at the annualized returns, the average annualized return for the S&P for that period was 6%. But the median return, this is where it really becomes important, the median return, the annualized return for that group was 2%.
2%.
So many people underperform just the simple market for 20 years.
Yeah, I think that this slide is great. It shows the tails of like the winners way on the apples,
Exactly.
and then on the left side you got the losers like General Electric and other companies that have had some tough times, negative returns, Mike.
And the impact of being positively skewed like that, the big, huge numbers skew that average to the right, you know?
And so I think that shows also time in the market is very important as well. Not
Correct.
not timing the market. Don't time the market, folks, but time in
Correct.
in a diversified ways.
So, all right, so if we're going to go to asset allocation, we're going to start to build a portfolio. Fundamentally, you have two approaches you can do. You can use an active approach or you can use a passive approach. And basically, in the most simplest terms, it's like this. Active approach, you're stock picking or you're manager picking and or market timing, or you're picking sectors to be in, et cetera. But it's all strategic moves, moving in and out, versus a passive portfolio where you're focused on asset allocation. You can do this with index funds. You can do it with asset class funds. You can do it with index ETFs. All are broadly diversified. You can be had very low cost, and just a better way to build your portfolio. And they're very tax efficient on top of that as well.
Can you speak to one thing on this slide, Mike? Is that I think for many investors are like, wow, I want to have someone out there who's being active for me, that like, man, they study the market the whole day long. They've got they've got some articles they're reading.
Right.
Like, why is it that it's easy for people to grab a hold of the active versus the passive? I mean,
I just think, I guess if you're from an entrepreneurial standpoint, if you look at that, you work hard, you have success, and you try to put that into the market. And surely if there's smart people in the market and they can beat it, but there's a lot of smart people in the market. It makes them highly efficient. And yeah, there are people that win, but I mean, that's another topic for another day. But I mean, how do you determine whether it was luck or skill? That's very difficult.
And that's a show coming up, folks.
Very
difficult. Luck and skill coming up.
We'll bring our professor from Bradley back in for that one. Yeah.
Very good, very good.
So if you take a look at let's just show that here's the data, and this is really good data, and you can actually access this data on the internet. Standard & Poor's, think of the S&P 500 index, that's Standard & Poor's. They have a data, it's called the SPIVA scorecard, SPIVA scorecard. That's where this data came from. And what they do is they track the performance of all mutual funds. And they've got a big database. And actually, they have more 20 plus years of data now. And they do it by each asset class. And they've got 20 years of data. And I think if you go to the actual website and look at the data, it's very similar to what we're seeing here. U.S. stock funds for the last 10 years in this data, 11% beat their relative index.
Yeah, let's stop there just for a moment. I mean, we've talked about some advisors here in town that actually just do stock picking, and that's how they put together their portfolio for their clients. I mean, look at what the data is sharing here, Mike.
So, and these are all the pros. So think of the resources these firms have. These have
exactly
much more than just a little local firm. But if you're going to pick an investment strategy, and I tell you the odds of your winning are 11% versus 89, which one do you want to go with? And it's not much different. You look across all these other asset classes, international stocks, it's a little different, but it's still very low. Emerging stocks, short-term government bonds, global bond funds. That's the only one where they've shown some skill. It's just not a good plan for success. And then when you go further with this and you look at, because you've got to think about this, a lot of people have taxable money on top of this. And then you look at the inefficiencies of active management with investing and what it does to your returns. You look at this, this is the ultimate active approach, hedge funds.
Yeah.
You need if you want to generate a net 5%, this is what this is showing, you've got to have almost 8% to make up for the fees and taxes on a hedge fund. That's a high hurdle. And then if you go to private equity, that's another one that's out there for rich people that think they're succeeding. You got to earn close to 5.2% just to get to 5. And now we get to a mutual fund, the active managers, it's above 3%. And with an index fund, it's only 1.8. And if we were to look at asset class funds and ETFs, you could probably even shrink that margin more. And that doesn't include the fact that if you've got an advisor that has a strategy where you're lost harvesting and rebalancing, you can focus on asset location as well. There's other things you can do to compress that.
Right. And I think as a supplement to this slide here, we want to give you a little bit. This is some great data, Mike, but we're also going to give you an article from a Nobel Prize winning economist, William Sharp, The Arithmetic of Active Management. It's just a 2-page, you can kind of read through that and say, like, wow, that has really opened my eyes on how these fees and churn of their accounts can just crush the rates of return for most retail investors.
Right. And he won the Nobel Prize for that, by the way. I mean, because William Sharp,
He's good stuff.
great research.
Yep.
Yeah. So there's a whole bunch of research that is behind all this, and I'll put this slide up here. I'm in the kind of the deep data on this, but a number of these guys, Harry Markowitz, Daniel Kahneman,
Thaler's good on behavioral.
William Sharp's here, Fama.
Oh, Fama are one of my favorites.
Ken French. I mean, Thaler. I mean, there's a lot of Nobel Prize winning research that goes behind what we're going to talk about. That we always talk about.
Mm-hmm. Mm-hmm.
So I'm going to share this with everybody. This is a slide data that just shows you can build a really good globally diversified portfolio with 2 ETFs. And these are with a company called Vanguard. They manage $7 trillion. We use some of their products. They're very well diversified, very low cost. And in this particular portfolio, we have 30% to their international ETF, 70% to their US ETF. You get almost 12,000 stocks in your portfolio, broad diversification, and it's cost you 0.03% for a portfolio cost. Very low cost. Great way to start a portfolio on the equity side. Now, again, you're going to have to blend in fixed income with this, but that's a great equity portfolio at a very low cost.
Do-it-yourself type one.
Very simple. But you could go one step further. We like to follow an evidence-based approach and then follow asset class funds. And evidence-based investing is very similar to index investing, where it's premised around markets are highly efficient, risk-reward related, investments should be diversified, highly diversified, not 70 to 80 stocks, many asset classes, thousands of stocks, many countries. But then we're going to pursue factors of return. We'll talk about that more. And then we're going to focus on what we truly can't control. And it's not market timing and it's not stock picking.
Yep. Discipline, structure, we can control that.
Correct. And to provide people a little bit more deeper view as far as the difference between evidence-based and active investing, evidence-based investing advice relied on academic practitioner research. We believe that outperforming the market is difficult. Factor tilts offer the most reliable way to put the odds in your favor. We'll talk more about that. Maintaining low cost is incredibly important. That's what we can control, right? Cost.
Yeah.
And then active investing advice based on, beliefs about the markets, very subjective, very tough to beat. The data showed that already. They believe that outperforming the market's easy, right? But it's,
good luck.
It's that
That's
sophistry,
tough.
all that rhetoric.
Mm-hmm.
Yeah. So when you look at asset class investing and what it offers, you get a lower, again, I don't mean it's like a record here, but lower cost, you get better tax efficiency, increased diversification, better risk exposure to asset classes, and potentially long-term performance. Because we do, there's no certainties in investing. And if we don't take a look at the asset class returns, here is data for the last 20 years on asset classes to kind of give people an idea on asset classes. And these are like U.S. large. If you look at that, you can buy an asset class fund. The returns have been really pretty much with the index benchmark. But if you look at the returns for the active managers, are almost 2% less.
Mm-hmm. Incredible.
And if you look at U.S. value, you're at you're close to a little over 2% higher than active managers. Same thing for small cap. Now you get down into 5 years, global, it's been a wash, and you get into international value right now. For the last 20, it's been a wash. But that, again, there's randomness and there is no perfect answer to this.
There's no perfect answer. Let me
longer term data would show better results.
Well, I think, Mike, if we looked at over time the impact of 1 or 2%,
it's huge.
Oh gosh, guys, remember what Albert Einstein said? Exponential compounding is the most powerful thing in the universe, and if you are not getting those normalized extra 2 and 1.5%, you're really losing out. You're getting creamed on this, and I think. That's just one thing to consider.
Yeah, and it's kind of a risk. If you look at asset class investing, it's around the premise of risk and return, right? If you look at the asset classes and you look at it, like this data here, inflation's been historically about 3% since 1928. Long-term government bonds is almost 6%. the market, S&P's at 10, but then you can get into large values, a little over 11, small caps a little over 11, and then you get in small U.S. value stocks that have done almost 13%. So, I mean, you can build a portfolio with all these different asset classes and get a better long-term experience, increase your odds of success.
Yeah. Go ahead. I love that slide. This is a simple little slide. Okay. I was thinking about this in pre-show here a little bit. And, this shows two different individuals who take a diverse asset class investing versus maybe a single stock investing. You might get to the same end zone, right, end point, but look at what the person on the top of this slide had to go through. And what would happen if halfway through they had to sell? Like something happened, like right, a health event, or they maybe moved. And what happens if they needed to pull the money out halfway through that roller coaster?
Well, and also, think back to deep risk and shallow risk you talked about. That doesn't play out in this, but you can actually have some of your individual players go to zero, or something that you bought, like one of these equity index funds that they tell you you're taking this roller coaster that's nice and smooth, but you end up having a return that is so minimal that you impact your goals incredibly.
Yep. Just a fun little slide there.
Yeah. So the one thing I think we should throw out here, because I think I see this a lot with people, and especially with the last decade, because international returns have been muted compared to U.S. Mm-hmm. But if people would step back and look at the previous decade, the opposite occurred. U.S. returns were negative, and the international returns were highly positive. And you have to think about this when you're investing in capitalism around the globe. The U.S. is great. Granted, we're a big player. We're still over half of the U.S. or the global market. But mm-hmm. There's a lot of other countries out there that provide this. And to not invest around the world, you're missing out on that, and you want to be diversified.
What you're doing there, Mike, is you're actually just taking a bet on the growth of the global economy. You want to capture,
right?
You're betting on capitalism.
Yeah, in the long term, we're all going to, regardless of what happens, we all get up in the morning, we put our boots on, and we go back to work. Mm-hmm. The key is you want to dampen some of that risk, and I think this is nice to show this data to people.
It's my favorite slide.
This grid here basically shows a number of different asset classes, and then what we do, if you look at the white in the middle where it's kind of smoothed out, that's a portfolio that's built with 65% equities diversified, and we'll show you that going forward, 35% investment grade fixed income, and it dampens the ride. Mm-hmm. And we're going to show you what's more important, not as much when you're accumulating, but when you're spending from a portfolio, that dampening is huge. And we're going to talk about that.
Before you go, Mike, I want to make sure that those viewers understand that color-coded slide you just showed, that there was the last several years, the U.S. large cap has really kind of outperformed, but they haven't always done so. Also in that slide, cash has been in the top 2 or 3 in 2 of those years on there. So even a cash investment can lead to better yearly performance than equities.
Well, what an incredible story. If you go back to 1929, there are 3 periods where in excess of 10 years, cash, basically a 30-day treasury bill, beat the S&P 500 index. Mm-hmm. And I don't think people realize that, because they always say, well, 10 years is a really long term, Mike. But it's there's 3 periods in history here where cash beat the market for 10 years. So there's a lot of randomness out here.
Absolutely. I love that. Diversification can be your buddy.
Yeah. Yeah. So here's what that portfolio looks like compared to the S&P 500 index. So what it's broken down. We show the different asset classes and break it down. And here is the actual returns then since 2000 to 2019 for both of those. So you got the S&P at 6. You got the diversified portfolio trailing at 5.4, right? Mm-hmm. But the standard deviation, look at the difference, much lower. That's the bouncing up and down, right? The downside volatility and the upside. And what's more important is here we are, the data is like I was talking about, this is where it really is important, is if you're spending from your portfolio, say you're taking 5% from your portfolio, the S&P portfolio, the non-diversified portfolio, crashed and burned in 2015, was out of money. This portfolio, you still have $200,000 left, and you spent almost $700,000, and that's where it really pays out.
Diversification pays off.
Yeah. So again, to end this up, I guess we're going to focus. The thing is, you want to focus on what you can control, and the number one thing is you want to have a plan that's written, so you're not just moving in the wind, right? You know what your plan is and where you want to be, and what you're based on your risk tolerance, and whether you're a stock or a bond. I think that's important. We kind of alluded to that briefly, but I'm a stock. If you think about me on human capital standpoint, and Joshua is a bond, and by what I mean by that is he's a college professor. He's tenured. His income is independent of any recession, depression, whatever.
I hope so.
I'm an investment advisor who charges on a percentage of assets. My wagon is hitched to the market. So my human capital, I am much more like a stock. So when you craft a plan, now even though you can, based on your need, ability, and willingness to take risk, you need to take a look further at your human capital. Are you a stock or a bond? That gets into play too. So we're going to build a portfolio along expected returns, and they're lower than what historical are. You diversify, and then what the thing is, we're going to focus on managing expenses, turnover, taxes. And taxes is not just getting at the end of the year and paying your taxes. It's tax loss harvesting, asset location, spending strategies, et cetera. And then finally, as we've alluded to, the main thing is the discipline and the behavior is huge.
Oh, it's
not just from being in or getting in or out, but it's also chasing, and there's recency and all kinds of things.
Yep.
That was a mouthful today, but I think it was good.
Well, you did a good job explaining the importance of diversification, and even like having your money last. I mean, if you're not diversified, you could find out like in those down years that you like that roller coaster slide. Oh gosh! And do you have a little? You want to show us from Larry Swedroe, one of our favorite guys?
This is a book from Larry Swedroe. He's a director of research for my back office, and it's his most recent book. I think Larry's written literally 20 books. I don't know of anyone who has helped probably more people and got nothing in return for it than Larry. The man is totally passionate about this. I'll put this out on the website so people can resource this. This is a great book if you want something to read to really help you walk you through everything. And maybe we'll have Larry eventually. I'll bring Larry on. We can talk one day. I've had if you research it, I had Bradley a couple times. And on YouTube, you can Google Larry Swedroe Peoria. They're an hour long, but they were great talks.
Oh, he's fantastic. He's just like a walking knowledge, like a library of knowledge on finance. Well, folks, thanks for joining us on today's episode on building your portfolio. Again, building a portfolio is so important for long-term success. Don't just throw money in the wind at the most recent thing like the Rivian stuff, although we want Rivian to do well. Just people are FOMOing into crypto, as our producer would say. Just get into like something that is evidence-based investing and ride it out with a diversified way, and you will be successful.
Yeah, there's a lot of great options out there for people that they can use.
Yep. Thanks for sharing all this stuff, Mike.
Good, Dale.
Yep. This is the Enlightened Investor team out.